If you're looking for a quick summary of IFRS 2 share-based payment, this video is for you. What is a share-based payment? A share-based payment is a transaction in which the entity receives goods or services either as 1. Consideration for its equity instruments, or by incurring liabilities for amounts based on the price of the entity's shares or other equity instruments of the entity. The accounting requirements for the share-based payment depend on how the transaction will be settled. That is, by the issuance of A. equity, B. cash, or C. equity or cash. Scope of IFRS 2. IFRS 2 covers a wide range of share-based payment arrangements, including the issuance of shares or rights to shares for services and goods. It applies to all entities with no exemptions for private or smaller entities. It includes subsidiaries using their parents' or fellow subsidiaries' equity or consideration. Next, exemptions to scope. 1. Business combinations involving share issuances should follow IFRS 3. 2. Share-based payments covered by IAS 32 or IAS 39 should use those standards for commodity-based derivative contracts. Next, excluded transactions. Share dividends, treasury share purchases, and issuance of additional shares are not within the scope. How to recognize and measure. 1. Issuance of shares or rights to shares increases equity, with the corresponding expense recognized when payment doesn't represent an asset. 2. Expenses are recognized as goods or services are consumed. 3. For fully vested shares, expenses are recognized immediately, while those with vesting periods are recognized over that period. 4. Total expense for equity settled share-based payments is based on vesting conditions and grant date fair value. 5. Market-based performance conditions affect the fair value but not the number of equity instruments. 6. Non-market performance conditions are considered by adjusting the number of equity instruments in the measurement. Last, measurement guidance. 1. Fair value is determined by the value of shares, rights, goods, or services received. 2. Employee share options are typically valued based on the equity instruments granted. 3. Fair value should be estimated at the grant date for equity instruments and at the date of receipt for goods and services. 4. Market prices are used when available. The valuation techniques are employed when necessary. Intrinsic value can be used in rare cases where fair value cannot be reliably measured, but it requires remeasurement until final settlement. 6. Market-based performance conditions are considered in the grant date fair value, while non-market conditions affect the number of equity instruments and are adjusted each period until vesting. This is the entire summary of IFRS 2. Subscribe to Mango Accounting for your daily dose of accountancy.